Friday, there was a call on or a question on the Kerry's call about somebody held a position in Iris Energy, and they were down 40% and what to do. And I was a financial advisor for 22 years. And the one thing they never talked about, or if they did talk about it, it was very briefly, and that was risk management. It was always about markets going up, about stocks going up, this, that, and the other, never about risk management. And so when that question came up on Friday, I sort of came out of my skin. I just wanted to go ballistic, to be honest with you. And what I was taught as a financial advisor by Ameriprise initially, and then even from our independent broker dealer, was that you risk manage through diversification and time in the market. And they always referred to the last 100 years, the S&P, the market has gone up 10%. They never talked about devaluation of the US dollar, and they never talked about any of that. And so it was, and what I realized halfway through my career was that they want to keep you invested because that's how they make money. They take fees, they collect assets. If I make a 90% payout, they're making 10% of my assets under management on the fees that I charge, right? So after Liberation Day for me back in April 1st of 22, and I sold my practice to my business partner, Valerie, I started looking for the truth of all this. And one of the things that when this person said they are down 40%, what should they do? And in all respect to Kerry and how he invests, that's fine. But he is down as well. I started thinking about what do people think when they think about investing? What do they think about when no longer, everybody talks about, oh, I'm a long-term investor. Well, no shit, right? If you're doing this and you plan to be investing for long periods of time, you're a long-term investor. It's how you approach the investing. A short-term investor is somebody who comes in, say, with $5,000 worth of capital, tries to make it happen, drains their account to zero, and then never invests again. That's a short-term investor. So here, everybody here is a long-term investor. The key to this is preserving capital so they can keep going on. And so I went on Grok and I asked the question, if I had a $10,000 initial capital account and I had 12 positions in it, and I ran 8% to each position, and I ran certain levels of stop losses behind them, how long, and I had no winning trades, no investments. And when I got stopped out, I reinvested the capital based on the 8% of whatever was left after each time. How many times would it take me to drain my account to zero if I just ran different levels of stop losses? And I was actually really surprised. And so I put in, if I ran a 7% stop loss, how many times? And this means I allocate 8% to 12 different investments initially. I run a 7% stop loss. And then every time I get stopped out, every one of those, that's a cycle. And I start to reinvest. Well, it told me that it would take 199 cycles at 7% to drain my account to zero. If I can't figure it out after 50, maybe I got a problem. Maybe I shouldn't be doing this. That's 2,388 trades. If I would use 10% as my stop loss, that's 138 cycles, okay? It's when you get down to 40%, you only have 29 cycles before you're out. That's 348 trades. If you bail out at 60% and you do this, have a 60% stop loss, you have 17 cycles and then you're zeroed out of your account. You have no money. And what this tells me, and what in looking at this and looking at this data, it tells me that if we're not managing our risk. And let's just say we use a 15% stop loss on companies that we plan to hold forever. So let's say I buy Berkshire, right? And I tag on a 15% good till cancel trailing stop loss. It's going to take me 89 cycles or 1,068 trades to zero my account out. Okay. I'm still in the game. And this is figuring you have no winning investments. Okay. You're just a
Yeah.
loser at picking stocks, right? You are just you get a gold star on your helmet because you're going to need a helmet because of you're just so bad at this. It's going to take you 89 cycles or 1,068 trades. And what I would in today and last night when I saw the White House newsletter come out about China and US and China have come to a deal, I knew the market was going to skyrocket because it's a news driven event. But nothing came out on non farm payroll, nothing came out on CPI, nothing came out on consumer spending, nothing came out on credit card delinquencies, nothing came out on, nobody came out who had reported earnings last week or the week earlier and said, hey, we're revising our guidelines. Everything's wonderful. Nobody did it. The only thing that changed was a headline event. And we're now, Marcus pointed out, we're seeing major gaps up. Well, these major gaps are just based on a headline, 10 word headline on CNBC that's driving this higher. Nothing else has changed. So as you get these gains back, and that person who was down substantially in Iran, and you get a gain up, just think about what is your risk management policy? What are you doing to protect your capital? And maybe, just maybe, should you put in a good till cancel trailing stop loss? Because if you bought, say, Iran today, which is going to open just over $7, and you bought it there and you put a 7% trailing stop and the stock went up, it just, let's say it just doubled. That trailing stop is going to tick up with you. And if it comes back down and retraces, you're going to stop out, but you'll stop out with a profit. Versus if you don't have a stop loss, you just go back to zero or even less. And I think this is so important. And you think about how in professional investors, professional traders, the number one thing on the to-do list before buying a stock is how much am I willing to lose? And everybody has a calculation for that. Everybody has a secret formula. Mark refers to, I've referred to, Paul Tudor Jones. It's not secret. He has just one line in the sand, the 200-day moving average. If it drops below that, he's out. Okay. I think you need to have a little bit more sophistication, but that is his baseline. He probably has way stacks more of risk management there. But I think this just proves to me that if you're just starting to invest, or if you're a seasoned investor and you don't have some sort of risk management process for your long-term or even short-term investments, you can easily be broke really fast. But if you do have a good policy, I mean, even 20% on a long term, you still get opportunity to stay in the game. And tomorrow, I'm going to hit about allocation percentages, how much to consider allocation wise of your portfolio to one investment. And then I want to hit upon different ways you can use different indicators on how to determine your, especially for swing trading and short-term trading, how to determine what your stop loss should be. And so this week, I'm going to make it a focus on risk management because I think this is the one thing I was robbed of by companies like Ameriprise, by my last independent broker dealer, was that nobody sat down and said, let's get into the nitty gritty of risk management. And I think this is the number one thing that should be being taught at every level when it comes to investing, how to stay in the game. If you want to know who the best risk managers are on the planet, flip on ESPN around 11 o'clock at night and look for the World Poker Tour. These guys are the best risk managers because in their game, if they have no more money at the table, they're out of the game. And that is no different than what we're doing here.